Hey everyone, in this video I'm going to answer which one I think is the better growth stock to buy, Snowflake or DocuSign. I'm going to compare these two on some critical financial metrics, including revenue, cash flow from operations, shareholder dilution, and valuation to determine which one I think is the better buy. So let's jump right in. Let's take a look at this comparison.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, the first thing to look at between these two is revenue. And looking on a trailing 12-month basis, you can see they're similar in terms of revenue at around 2.8 billion for Snowflake and 2.7 billion for DocuSign. But what's also noticeable is the slope of growth or the rate of growth. You can see Snowflake is growing much faster than DocuSign. You can see Snowflake started out considerably behind DocuSign in mid-2020. And now it's surpassed DocuSign in late or early 2024 in terms of trailing 12-month revenue. Going forward, I suspect Snowflake will surpass DocuSign even further. The gap will be wider. Snowflake is expected to grow at a faster rate than DocuSign. DocuSign is facing more competition than Snowflake. And so that's going to limit its growth because it's not going to be able to win as many contracts as Snowflake. Regardless, each of these two have a strong tailwind behind. DocuSign, e-signatures, so much more convenient than signing documents on paper. That's an opportunity for many of these companies like DocuSign and Adobe to convert the legacy methods over to the digital methods, and that could provide a tailwind going forward. It's a win-win situation. Customers prefer signing documents digitally because it saves them time. Businesses prefer because it saves them time and it saves them storage expense, and it's easier to search these documents when you need to find something to search them digitally versus having to go through all your file cabinets to find these documents. Snowflake, the tailwind behind Snowflake is data analysis, data storage. Data is the foundation for building artificial intelligence models, and that's going to fuel growth for Snowflake for several years into the future. So the next thing I wanted to compare these two on is cash flow from operations. Cash flow from operations is one of the most vital metrics I consider when making an investment decision. If any financial shenanigans are happening, looking at this metric can help uncover the fraud. Moreover, looking at profitability without considering cash flow from operations can lead to a misleading picture of a company's performance. For instance, look at the example I have created here. The company reported a net loss of $250. However, when you look at the cash flow from operations, it was a gain of $35. How can that be? Well, two expenses a company must report on the income statement are depreciation and stock-based compensation. Importantly, these are non-cash expenses. Money is not leaving the company for these expenses. In the case of depreciation, when a company buys a machine for $750, it pays all of that price up front. However, generally accepted accounting principles require that the company take the expense over a period the machine is expected to operate. So if the machine is expected to last for 10 years, the annual expense will be $75 per year for 10 years, even though the company paid the $750 cash at the time of the purchase. Also, when a company offers its employees a stock option, it's not parting with cash. However, it must record the cash value of the option as an expense on the income statement. So moving on to the working capital items, inventory management is the easiest way a company can increase cash flow. The simplest case is when a business has 100 inventory units, sells 30 units, and doesn't replace those units. The decision would reduce total inventory and increase cash flow. As you might already be thinking, this isn't sustainable. Eventually, the company will deplete all its inventory and go out of business. Accounts payable is the money that a company owes another company and has not paid yet. And accounts receivable is the opposite. A company can increase its cash flow by collecting payments faster and paying suppliers slower. If done with skill, companies at scale can take advantage of these timing differences to boost cash flow by a couple of % annually. Costco is one example that employs this strategy masterfully. Overall, if you observe cash flow increasing unsustainably, you should expect a reversal of that trend. The other big risk to consider is if you see a company reporting substantial profits but negative or weak cash flow due to rising accounts receivable. So now that you get an idea of why this is important, you can see DocuSign and Snowflake, again, very similar in this trend here at roughly 31% for DocuSign and 30% for Snowflake. But again, Snowflake demonstrating a faster rate of growth here in this metric compared to DocuSign, although both at 31%. This is an excellent metric for this number. The next thing I want you to understand is shareholder dilution, or average shares outstanding. The number of shares outstanding is an important financial metric. If a company issues more stock because it is running out of money or it wants to invest in a new growth project, it has the potential to decrease your earnings per share. Look up here, when I have a net income of 1,000 and shares outstanding of 100, my earnings per share is 10. You take the net income divided by shares outstanding and you get 10. But now let's say you increase your shares outstanding to 200 and you have the same net income of 1,000. Now your earnings per share is just 5. The same is true in the opposite direction. If a company is losing money on the bottom line and it issues more shares, it spreads out the losses across more shares, thereby reducing the loss per share, which is a tricky way to reduce the loss per share. Look at this point here. A net loss of 1,000 with 100 shares outstanding creates a loss per share of 10. But if you take that same net loss of 1,000 and you spread it across more shares, 200 shares, you now have a net loss per share of just 5. So it's a tricky accounting trick to get your losses reduced on earnings per share. So you want to take a closer look to see where the improvement in the loss per share is coming from. And so now that you understand that, you can see they're both diluting shareholders, but Snowflake again is diluting shareholders more quickly than DocuSign, which is not a good thing, right? In this metric, you don't want to be the leader. You want to be diluting shareholders a little bit less, but Snowflake diluting shareholders more so than DocuSign. And then finally, I wanted to look at valuation, and according to the forward price to earnings ratio, Snowflake is considerably more expensive at a forward PE of 127 versus DocuSign at a forward PE of 17. Now, if these two were trading at the same valuation, it would be a no-brainer. I would choose Snowflake. However, I don't believe Snowflake deserves this much of a premium valuation over DocuSign. So if I was to pick one of these two growth stocks today, I would pick DocuSign. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.